Adrian, can you email Nick the Zoom link again? He's saying he doesn't see a passcode. It shouldn't require a passcode. Can you send him the entire link?
Yep, sending it to him again. Okay, here we go. Okay.
I see you. Hi, everyone. How's everyone doing? I know we're streaming on Facebook also. Thank you, everyone, for being patient. Nick is with us now.
Hi guys, sorry about that. That's my fault.
No, no worries. It happens. I was getting a little nervous. But no,
No, I clicked the
this
wrong
is
link.
great. We're already streaming on Facebook and YouTube, so we should be fine, Nick. We'll do just fine. Okay, awesome.
Okay,
Just
great.
a quick few housekeeping items. If anyone on Facebook, can you give me a thumbs up to let us know that you can hear us okay? That will help. And then, as always, guys, I'm going to be asking Nick a bunch of questions so he can walk us through things. Nick, the plan is to talk about year-end tax strategies. I think that'll be great for everyone because we're, like last few weeks here. And then we'll talk a
Sure.
little bit about the election and, how you predict that's going to affect tax strategies for real estate investors and then the more generic stuff. But for
hmm
those of you on, so we have our coaching students on Zoom with us. And so they'll be, guys, you can put your questions right in the chat. Those of you on Facebook, we'd love to try to get to all of your questions. Do you have a hot stop by any chance, Nick?
No, I'm good.
Okay, perfect. So, guys, we'll try to get as much as we can. After a certain point, we may stop, but just keep putting your questions in the comments in Facebook, and Aiden will help me with that. But super excited to get started. Anyone listening this later on replay, drop hashtag replay into the Facebook chat so that it helps the algorithm boost this podcast up and more people get to hear it. Okay, awesome. Let's get started. I'm super excited. I love talking about taxes, and Nick, I work with you so closely. I know you love it too. So very
Of
excited.
course.
Okay. Okay, guys, I know a lot of you are curious about how physicians are using real estate to pay $0 in taxes. And a lot of you are excited to learn about strategies that you can use before the end of the year to save dollars by, strategically reducing your taxes. I am excited to have Nick with me today. Nick leads Aiola CPA, which is a virtual CPA firm exclusively serving real estate investors. I've been working with Nick for 3 years now, I believe, Nick.
Yep. hmm
They specialize in tax preparation, tax planning, and accounting. And the best part is that Nick also manages his own investment portfolio. He has long-term rentals, STRs. Last time we spoke, I know you do
hmm
flips and you also invest passively in syndications. So we're very excited to deep dive into the tax efficiencies of real estate investing for both passive and active investors. A large part of our community invests passively in syndications, and then we have so many people, physicians and others in our community who are active investors, long-term, short-term rentals, all of that. We also want to talk to you about the impact of elections on tax policy and real estate investing. And then we're hoping you can share with us some power tax strategies so that landlords can use them before the end of the year. Okay, all very exciting stuff. I have been tapping into these tax strategies for the last 3 years, significantly reducing my taxes. A lot of our students who've gone through the Creating Generational Freedom program, some of them have used, short-term rentals to reduce their taxes by and there is a limit in terms of how much you can reduce your taxes every year, but they gotten losses over 800,000 in a single year because of acquisitions, and then they obviously have to spread that out. So much you can do when you're tapping into these strategies. So I'm super excited to deep dive into it. For those of you who want to learn more about the coaching program, hop on to generationalwealthmd.com/waitlist, and you can learn more about the program. We, typically only have doors open in the spring and summer. And I know a lot of you on here are looking at short-term rentals. Some of you are closing on them right now. Some of you are under contract. So that is super exciting. We will deep dive into some of those strategies. And I know a lot of you listening are investing passively in syndications with us, with other sponsors. We're going to be talking about both strategies that all of you can tap into. We always have passive syndication opportunities. If anyone is looking to tap into 60% bonus depreciation before the year ends, go on to gwcapital.com. We have a deal now in Houston. Excellent, 85% tax exemption day one. So really solid deals. Hop on a call with the team and you can learn more. But let's deep dive into the tax part now, Nick. I want to start off by talking about the tax efficiencies of real estate for passive investors, because everyone gets super excited when we start talking about real estate professional status, the tax STR, loophole. But before, I always tell people that, there's so many ways we make our income in real estate. You have cash flow, and initially I thought it was just cash flow, but you have market appreciation when you're using leverage. That becomes powerful. You have debt pay down, and then the tax part, the tax savings part. And what I hear from a lot of physicians is that, well, I'm not going to invest in short-term rentals, or I don't qualify. I don't think I work full-time and my spouse does, so we're not going to get real estate professional status. So does it really make sense for us? Or I don't think we're tapping into the tax efficiencies of real estate. So let's start there. For some, what are the tax efficiencies that real estate affords that all of us get to benefit from?
I love this topic. Yeah, and this is a great one and a great starting point because it really gives people clarity on how to think about tax planning and how to think about investing and how they work together, because they do work together. Real estate is very tax advantaged as a default, even without going into advanced tax strategy. That amplifies it. The way I approach, and I say this to my clients too all the time, is the way I approach tax advisory, and I think the way everybody should approach tax advisory is that it is an investment. You're looking to save either tax dollars or time or both, for the cost of bringing that onto your team. And the way that I approach that is really in two different ways. There's two paths of tax advisory. The first one, like Pram said, it's the one everybody gets excited about: tax reduction, reducing your taxable income, reducing your tax liability, significantly reducing the amount you pay, or significantly increasing the amount you get back when you file your return. That's what everybody chases. That's what everybody thinks about when they think of tax planning. But there is another path, and that's what we're going to talk about now. And that's generating tax-free income, wealth building, and tax-free income that doesn't increase your tax liability. So one hand, it reduces your tax liability, and you feel that, you see that on the return. On the other hand, if you have W-2 income or K-1 income or 1099 income and you're investing passively, it won't reduce your taxable income, but it will generate more income that you're earning and putting into your bank account. And that income is tax-free. And that's what makes real estate so great, is because it is so often tax advantaged when you hold it. Long-term rental real estate, short-term, mid-term, passive investments and syndications, those distributions are usually tax-free all the way up until exit. And even if there isn't an exit, like a sale, there could be a refinance event that's tax-free to you too, because it's debt. There are plenty of ways for you to have tax-free influx of cash, and your tax liability stays right where it is, at the same place as if you didn't make the investment. So in the same kind of way, it achieves the same thing, in the sense that your effective tax rate on the amount of money you're earning is lowering. So they're both equally as important. They just look very different on the tax return, because that second path, that passive investing, is pretty much invisible on the tax return. But it doesn't mean you're not receiving that cash every month or however often you receive that. And then you have appreciation and favorable exit strategies, 1031 exchange to defer taxes, opportunity zones to defer taxes. These are all available to passive investors too. And even if you don't have a deferral strategy or a mitigation strategy, even if you sell rental property outright, you still benefit from long-term capital gains if you hold the property for more than a year, which is favorable tax rates. So just built into the tax code, real estate is advantaged even if you do nothing other than purchase it and hold it.
Yeah, and it's so powerful that I remember doing a webinar for a group of physicians, and I mentioned that with my first property, I had, over the course of 5 years, I had 40,000 in tax-free cash flow, and then I did a
Mm,
cash out refinance, and this was a property I put 30,000 into initially, right, as a down payment, and I had another 50,000 in in tax-free money, which I got because of the cash out refinance, which you just
mm.
mentioned, and people said, well, but you can't do that as a passive investor, right? And like you said, that is afforded to all of us, even as passive investors. If you're investing in syndications, if you're investing passively in long-term rentals or midterm rentals, all of us get to benefit from that. And I think that's something we forget to look at. Nick, can we talk about while we're on the passive side, right? When investors invest in syndications, again, bonus depreciation is something we take advantage of. Typically,
Sure.
right now, because we're at 60% bonus depreciation for every 100K they invest in a syndication, they get about 40 to 50K in tax losses. Now, there are physicians who have other sources of passive income that and they're getting that from surgical centers and
Surgery
endoscopy
centers,
centers,
right? Yeah, we see that all the
sometimes
time.
as short-term rentals. So and then they're paying taxes on that at their marginal tax brackets. And these syndication losses they can use to offset other forms of passive income. So let's talk about mixing and matching, right? Because that's what you do when you
Hmm.
say tax advisory. Now, like how you say advisory is opposed to planning, same thing. But
Hmm.
how else have you helped passive investors kind of optimize taxes essentially, even though they're still on that passive side with syndications or long-term rentals?
Yeah, great question. And this is something that's so important because we do have a lot of medical professionals and physician clients who do exactly that. They have fractional ownership in surgery centers, and it doesn't only have to be real estate. Any investment that you have equity ownership of that you don't materially participate in, which is the opposite line of thinking when you're talking about reps and material
Yeah.
participation for short-term rentals. This is the opposite. If you don't materially participate in a business where you have an equity stake and a share of the income and profits, then that is a passive investment to you. It doesn't only have to be real estate. So you can have passive real estate losses from property you own directly, long-term, midterm rentals, or syndications that create these losses, like you're mentioning. If you invest X amount and you're expecting 40 to 50% of X as a loss, you can use that to invest any type of to offset any type of passive income on your return. One point of confusion that we see as a common misconception is that like interest, dividends, and capital gains from the sale of stock or crypto or any marketable securities, while technically in theory that's passive because you're not earning it, it's not considered passive income for the tax code. It's considered portfolio income. So we're really talking about business or other investment income where you have equity ownership in an activity that you don't materially participate in. But any kind of passive income to you would qualify to be offset by passive real estate losses.
Yeah, awesome. Yeah. And then this applies to a lot of our coaching students who year two, they own a short-term rental. Year one, they're materially participating. They use the losses
Hmm.
against W-2 income, but year two, they're generating significant passive income from
Exactly.
that because they aren't materially participating. They can use syndication losses to mix and match there. So they're significantly reducing their taxable income over there. So lots of strategies. Guys, anyone interested in exploring our latest Houston opportunity, go on to gwcapital.com, book a call with the team. But this leads me into what I think a lot of people get very excited about. Let's talk about those advanced tax strategies now, right, Nick?
Hmm.
This is what allows people to shelter, what is it in 2024? It's $625,000 of W-2 income that they could potentially shelter from taxes.
Even more, 646, I think, is the number for 2024. So yeah, right around 650,000 that you can shelter on your W-2.
Awesome. So let's talk about real estate professional status and the STR loophole now.
Of course. Yeah, these are the heavy hitters. And this is what we were talking about in the beginning, that first path of tax reduction and reps and STR. The concept is the same in the fact that you're operating the business differently. You're spending more time in the business, and the goal of doing so is to be able to convert the activity from passive to non-passive, because that means you can use those losses to offset any type of income. And that non-passive classification, it's it applies to, like, so if you have that, if that's a short-term rental or real estate professional, you can offset W-2 income. If you have K-1 income, 1099 income. Ram, what you were talking about, that limit, that's called the excess business loss limit. So there is a limitation on how much W-2 income you can offset each year. If you're married filing jointly, that's 646. If you're Single, it's a different amount, roughly half that. And that's how much you can offset against your W-2. However, if you're a partner and you receive K-1 income, or if you're self-employed and you receive 1099 income, that's considered business income, and there's no limit on how much you can offset against those two. So depending on how you
Oh, I
receive
didn't
your,
know that.
yeah, depending on how you receive your income, because as a partner, you own a share of a business, and as a 1099, you're self-employed. So W-2 is really the only, you're an employee of a company that you don't own. So it's not considered business income, but all business income together. Um, and like if you had, just quick numbers for an example, if you had 500K, um, let's use bigger numbers. That way we can introduce the limit. If you had 800K of a W-2 and you had 700,000 in real estate losses, using round numbers, 650 would be able to offset your W-2, and you'd have $50,000 excess carried over into the following year as a net operating loss. But if you had 800K in K1 or 1099 income, you could take a full 700. Even if you had more losses, you can offset the entire 800 plus the 646 against possibly other W-2 income. So all business income goes into one pot, and whatever the result is, that's when you start to introduce the limit. Hopefully that makes sense. It's a bit complicated, but
Oh, that's
uh,
actually amazing because I know we've had physicians, couples in our coaching program where they purchased two short-term rentals, and I believe they own the practice, so they're probably getting
mhm,
a significant portion of that income as a distribution or as K1 income, and so
mhm.
they had $800,000 in losses that they could use against their income. So I have a feeling they were tapping into more than just that
Yeah, that would be
600.
great. There's strategy there. So a lot of medical professionals have S corps, and
Yes.
as an S corp, you're required to pay yourself salary. So depending on, you got to pay yourself a W-2 income. So you're every time you run payroll for yourself, you're taking away some business income and adding W-2 income. So there is
Yep.
strategy on how much to pay yourself and what entity structure is best for you, and how that
Yeah.
ties into your real estate investments. It all goes together.
Okay, that's awesome. Now we had one of our members within the program. She was a radiologist, but she was a stay-at-home mom, and she purchased an apartment complex. She rehabbed it. She qualified as a real estate professional, and she was able to shelter over $500,000 of her spouse's clinical income from taxes. So let's talk about
Mhm.
the criteria someone needs to meet to even be able to do something like that. Let's talk about reps and maybe material participation a little bit.
Absolutely. Yeah, so reps is at its highest level of criteria. There's two main criteria, and that is you have to spend over 750 hours in the year on all real estate trades or businesses that you materially participate in. And the second one is over 50% of your time in real estate trades or businesses that you materially participate in. And that is an important end to the statement, that you materially participate in, because it is an aggregation. So real estate trades or businesses includes long-term rentals, mid-term rentals. If you're a real estate agent, if you're a property manager managing other people's properties, flips, developers, these are all real estate trades or businesses. So you could have, your hands in multiple buckets, and depending on how you split your time, you may be able to add the hours from all of those businesses into the reps bucket.
Hmm.
But you have to materially participate in each separate business in order to count those hours spent to the total. So it is important, like if you're a real estate agent, for example, or a property manager, you can't spend like 20 hours a year on your long-term rentals and expect those to follow into the reps strategy. It wouldn't work. You still have to materially participate separately in each separate business. Um, so 750 hours works out to be about 15 hours a week starting from January. And we like to have some cushion. So the real target you want to see is 800, 850, because we've been through, when you're in an audit, they can strike out some hours, and you don't want to be too close to that threshold. You want to have enough padding and level of comfort to be able to successfully defend in an audit. But those are the two main criteria. Below that, it gets a lot more complicated about material participation and which hours count and which hours don't count. And there's aggregation rules or elections rather, about grouping your properties together to make it easier to hit these criteria when you have a bigger portfolio.
Hmm.
Um, so there's a lot of nuance, but at the highest level, that's the main criteria.
Yeah. Now, short-term rentals, and this is why it gets very exciting for physicians, because as a physician who's working full-time, or as a couple where both of you are working full-time, it's hard, you're not going to be able to meet criteria for real estate professional status because
Mhm.
of that more time in real estate than any other income producing activity, right? So now that's why a lot of physician families, physicians, single physicians like investing in short-term rentals, because they can still go to work full-time, work overtime, and they can still meet criteria for material participation and
Mhm.
use the losses from that short-term rental against their active W-2 income. So let's talk a little bit about that criteria, because now they're not hitting they're not hitting real estate professional status criteria. All they need to do is hit criteria for material participation. So how does that work, Nick?
Yeah, the criteria for short-term rentals and material participation is much more attainable than reps. You can do this with a full-time job. I've done this myself, running a CPA practice and still able to do a short-term rental. It is truly attainable if you plan it correctly. The qualifications for a short-term rental, there's really three main criteria
Yeah.
that you have to hit in order to make this non-passive. The first one is the average length of stay to be defined as a short-term rental must be 7 days or less for the entire year. And that's for the entire property. So if you have like a duplex or a triplex multifamily housing, that's you can't have a long-term tenant in one unit and short-term the other unit and expect it to qualify for the short-term loophole. It has to be the whole property. The second criteria is personal use days. You can't use the property personally for more than a greater of 14 days or 10% of the days you actually rent it out in the
Mhm.
year. You working on the property doesn't count as a personal day. You being there to set up the property or maintain the property, repair the property, do anything regarding running the business is not considered personal. It's strictly days for enjoyment that you're there and not doing any work. Um, and then the third criteria is material participation. And that might look different for everybody. But in order to qualify as a material participant, there's 7 ways you can do that. There's one of seven, you have to pass one of 7 tests, but we really only focus on 2 of them. And those 2 tests, the reason we focus on those 2 is because they're only 2 that have quantitative measures, goals that you can actually plan out and hit and document. The rest are very subjective, much more difficult to defend in an audit. So we really target these 2. And the first one is spending 500 hours during the year. And that's it. That's a lot. That's a lot. That works out to be about 10 hours a week if you're doing it the entire year. So if you have one short-term rental property, it's really difficult to hit 500 hours unless you yourself are doing a ton of renovation or repair work. And when we have people with full-time positions, that's not usually the test we target. The second one that we typically target is 100 hours for the year, which is much more attainable. But the caveat is that you have to spend more than anybody else, more time than anybody else, non-owners or other owners, whoever, anybody who spends time on the property. So it adds an additional burden to you that you have to track other people's time, like cleaners and potentially contractors. And if you have a property manager or a co-host, that'll make it difficult. So it's important that you self-manage and at least in that first year and do a lot of the work yourself and rack up as many hours as you can. One of the biggest benefits of material participation that isn't often talked about when you see this strategy being discussed or in marketing materials, or you might see this on social media, but material participation for short-term rentals, you can actually combine, if you're married, you can combine both spouses' hours to attain the 100 hours. So if you're both doing the same exact thing at the same time, you can't duplicate those hours. But if you're both on the property doing different things, you're spending 5 hours at the property and each of you are doing different things while you're there,
Mhm.
that's 10 hours that you can knock out in a day. So it makes it much easier to attain that, especially towards the end of the year. That's not the case for reps. For real estate professional, it has to be one person. You can't combine hours. It has to be just one spouse if you're married that has to do all 750. So it is a much more lenient and easier. I shouldn't say lenient because in an audit it's just as stringent. You're going to need just as much documentation and just as much substantiation, but it's much more uh, easily attainable to hit that as someone who works part-time or full-time, or even somebody who is unemployed currently. It's still much easier criteria.
Now that we've kind of talked about both of those very fascinating strategies. It brings me to the question I'm most excited about. What do you think the impact is going to be on tax policy as far as having a Republican president in power?
Not only a Republican president, Republican Senate and House too.
True.
So, I mean, it's tough to say. You'll see a lot of times, a lot of during the election, both parties spewing a lot of information about what they are or aren't going to do to tax policy and any other policy. So we try not to get too deep into the weeds in the beginning. This is the part where we really start to sink our teeth in and see when the dust settles, what's really being discussed. This is a very interesting election cycle because every 4 years you're gonna have some kind of I guess notice of potential tax changes that are coming our way. But in this election, we have several tax laws and provisions that are set to expire halfway through the term. So when Trump was last in office, he passed the Tax Cuts and Jobs Act in 2017, which was a huge overhaul, the biggest overhaul of the tax code since 1986, and a big chunk of those tax law changes will be expiring in 2026 in 2 years. So whether something is changed or not changed with the current administration, there still will be a big change in 2026 because some things will either expire or they'll continue permanently or at least for a longer period of time. So even if nothing is done, there's still going to be changes, but we know that there's going to be still some proposed changes and see what happens. And I think the first one and most relevant one for us to discuss is bonus depreciation.
Mhm.
Um, for those of you that may know, there was an attempt early last year, to reinstate bonus depreciation retroactively to 2023 all the way through to 2025, reinstate 100% bonus depreciation. Made its way through the House very easily. It was a bipartisan bill, and it got stalled and ultimately died in the Senate. And it wasn't because of the bonus depreciation. It was because there was a child tax credit, proposed child tax credit change that the Republican Party didn't favor, and it didn't make its way past the Senate. Now that the Republicans control the House, the Senate, and the presidency, I don't see something like that being an issue. I just don't know where bonus depreciation lies on the priority list now that it's an election year and it's a new presidency next year. So I don't know. I don't know how far up that will be on the priority list.
Yeah.
It doesn't deserve its own bill, so they might just attach it to something that does have higher priority. And we'll see. We'll see. It's also equally important to discuss what won't be happening. Democratic Party was you've heard ideas about taxing unrealized capital gains
Mhm.
and limiting or extinguishing 1031 exchanges and other disadvantage, taking some advantages away from real estate investors. That won't. I didn't think that would happen if Democrats were in office anyway, but we can
Yeah.
guarantee that won't happen now.
Absolutely. On the topic of 1031 exchanges, Nick, there are some unique situations where someone may not need to do a 1031 exchange, and
Hmm.
this applies to our investors invest in syndications
Hmm.
and investors who are investing out of syndications, direct ownership of real estate. Can we
Hmm.
touch upon that briefly? We've had the lazy 1031 for a while now. What are the
Hmm.
other scenarios where someone does not need to think about a 1031 exchange?
There's a few examples. The most common and most, I guess, direct example is if you're selling if these are passive properties and you're selling, like a long-term or mid-term rental or even a short-term rental that you're not materially participating in anymore, anything that creates
Mhm.
a passive gain. Because if you're holding a passive portfolio and you have income over 150, chances are you have a nice bucket of suspended passive losses that you haven't been able to use for as long as you've held these investments. So a lot of times we see people sell property and it creates a passive gain and they have a mountain of suspended passive losses that have to go somewhere, and this is the perfect excuse to use them.
Yeah.
So in that case, you have a gain that you might not even pay tax on. You don't need a 1031. Other scenarios is if, like you said, lazy 1031, if you just don't want the pressure of abiding by 1031 timelines, the 45-day identification date, 180-day close date, and you're early enough in the year. If you sell a property early in the year, you may just decide I'll sell this property outright, buy a property before the end of the year, repeat the process with the cost seg, and defer the gain as individual transactions and separate transactions. Another one is if you do a cost seg on a property. If you're selling a property that you've done a cost segregation on, it makes a 1031 exchange difficult. And this is very complex and it's situational. So I don't know how in the weeds we'll get here, but basically, when you do a cost segregation, you're separating a portion of the purchase price into different components and different buckets of assets and how they're classified. And one of those buckets is 5-year property, which is 5-year assets, which is considered personal property by the tax code, and that's not eligible for 1031 exchange. And there's safe harbor thresholds and rules, and again, very technical and complex topics. But if you've done a property where if you have a property where you've done a cost seg and you're considering a 1031 exchange, you must talk with the CPA because there can be some real negative tax consequences if you go through with the exchange and seek guidance afterwards. It has to be done beforehand. So that's probably the biggest, I guess, red alert item is if you have a property that you did a cost seg on. Um, but yeah, I mean, that's one of the beauties of real estate is flexibility on exit.
Absolutely. And you brought up such valid points. And you talked about this in the beginning where you said some of the tax efficiencies that real estate investors get are tax-free cash flow, getting that cash out refinance, all of that equity, you can tap into that tax-free at any point. And then the 1031 exchange where you can
Mhm.
keep buying larger properties and, leveraging up by doing a 1031 exchange and deferring having to pay capital gains and depreciation recapture. But what you said, there are so many ways to play around with it where you could do a lazy 1031. You may be able to use suspended passive losses, which is why it's always important to tax plan. And I tell this to our coaching students and also to our investors and syndications, because I say when you get to exit, that's a good time to have a conversation with your CPA. So you know what your options are, and you may have more options than you think. You may not always need to participate in 1031. So
Mhm.
very valid point over there. And so my second favorite question for today is going to be, a lot of us, I mean, we have, what is it? 45 days to the end of the year at this point. So
Yeah,
can,
crazy.
and a lot of people on here are landlords. So do you have any year-end power tax strategies that people can tap into, what they should be thinking about as we're heading into the last few weeks of the year?
This is why I love tax planning because this conversation looks different for everybody. I heard you mention at the beginning that there are some people who are closing currently or some people who are in contract.
Yep.
If you're in that group and you're about to close this close to the end of the year and you're targeting the short-term rental strategy, there's a lot of work ahead of you. It's very doable, but those that group of investors really needs to understand the requirements ahead of to make the most out of these next 45 days or 30 days or maybe even less than that when you actually close on the property. There's a lot that has to be done. So right now, the bulk of my time at the end of the year currently is having these conversations with investors in the same boat. When's the close date? When can you get in there? How soon can you get everything done? When can you get a guest in there? Are you tracking this? Do you have an accounting system set up? These are all questions I'm firing at them because I want them to be prepared and I
Yeah.
want you guys to be prepared too. So year-end strategies for somebody in that position, it'll be very hectic. It'll be a very hectic month and a half. But the juice is worth the squeeze. People who have already had properties, maybe you have a longer runway and you're well on track to hit your material participation, or if it's passive, maybe not the pressure to do that this year, and you just have, again, like we talked about, tax-free cash flow coming in and don't really need year-end tax strategy because the investment itself is already tax advantage and potentially tax-free. So it really depends. Business owners is a 10, like we said, 1099, self-employed individuals. There's other strategies that we talk about, accelerating expenses and funding retirement. And you have an S corp, making sure you're taking advantage of your home office and accountable plan and Section 280A rent deduction and all of these things that we want to put in place before the end of the year. Because once January 1st hits, 98% of the strategy goes away.
Yeah.
You can't do much you can't rewrite history. So once the year ends, we don't have much at our disposal to be able to reduce taxes. And that's something that we hear, unfortunately, too often when we get to tax prep. Is there anything that can be done to lower this balance due? Is there anything
Yeah.
I can do to reduce my taxes now? And the answer at that point is usually no. So we really focus on proactive advisory throughout the year. And when we get to the end of the year, we look really closely at the individual's tax situation and their goals, make some recommendations, but still enough time to get some stuff done. If people are looking for an investment now, we make recommendations too on what types of investments will reduce your taxes, and it doesn't always mean real estate. But we're conscious of the time of year and what's necessary to have happen in the next 45 days and what's realistic and what we could again defend in an audit. That's the most important thing. So again, that looks different for everyone, but there are options out there.
Yeah, such valid points. I know you kind of compressed everything because I feel like you could have deep dived into each one of
Oh
those
yeah,
things that you
it's hard
mentioned,
for me.
especially when you talk business owners.
So,
And
yeah, yeah.
I have the same problem. And like you said, if for passive investors, we don't know what's going to happen with bonus depreciation. And so if you are looking to tap into 60% bonus depreciation, lock in those higher passive losses, we still have a few opportunities as far as syndication. So get in touch with the team, gwcapital.com. But I want you to talk about business vehicle deductions, Nick. And if someone's thinking about that and they want to, purchase something, how does that work with Section 179 and does bonus depreciation come into play there at all? And is it
Mhm.
easier to meet criteria end of the year? And does it affect things at all?
Yeah, so business vehicle is a great year-end strategy, and that's one of the strategies we recommend is looking to buy a vehicle, not only for your business, but you can also do the same exact strategy that we're going to talk about to make the vehicle itself its own business, renting out a vehicle, like using Turo for vehicles like you would Airbnb for a short-term rental. You can make the vehicle itself a business. You can be a W-2 employee and still have a business use of a vehicle if you make the vehicle itself the rental business. So this is a good year-end tax strategy because it's much easier to go buy a car than it is to go buy a house. So you still need to materially participate to make that work. But if you're going to attach it to a business that you already own, if you're a business owner, you can buy a business vehicle. It has to qualify for bonus depreciation or Section 179. So in basic terms, that means it has to be over 6,000 pounds. If you're going to buy a pickup truck, the bed length also has to be over 6 feet. So there are criteria that you have to make sure you're buying the correct vehicle. You can't buy just any vehicle and expect it to be bonus depreciable. But if it meets those criteria, you have to make sure you use the car at least 50% of the time for business based on mileage. So you have to track your mileage. In that first year when you're eligible for bonus depreciation, because you're only eligible for bonus depreciation that first year, uh, obviously we want to see you use it as much for business as possible. The catch here is that you have to use it for over 50% of the time business use for 5 years. Otherwise, if you dip below 50%, you can recapture some of the depreciation that you took in a previous year. So buying a vehicle now at this point, using it for business this month and a half, and then converting it to your primary vehicle won't work. You have to genuinely have a business vehicle. Um, so you mentioned a good question about Section 179 versus bonus depreciation. Section 179 allows you to write off 100% of the vehicle, assuming it meets those criteria. Bonus depreciation this year, as we talked about, it's the same as on a vehicle as it is for any other bonus depreciable property. It's 60% this year. So on the face of it, it looks like you would get more doing 179, but it really depends on the business. Section 179 only allows you to write off an amount equal to the amount of net income. So if you have a business that earns $10,000 net income, like $100,000 gross income, $90,000 of expenses, and your net income is 10K, and you buy a vehicle worth $40,000 and you do 179, you're only going to get a $10,000 write-off. It can only bring you to zero.
Mhm.
Bonus depreciation can create a loss. So in certain instances, bonus depreciation, even though the deduction might be less percentage-wise on the total cost of the vehicle, you might be able to get more tax benefit because it can create a deductible loss that you can use to offset other income. So again, situational, depends on your situation, your business's income, but both are available to you. It's just a matter of which one's the better option.
Awesome. Oh my, that's so valuable. I'm hoping everyone's taking notes over here. Nick, thank you so much for doing this. I feel like the year-end tax strategy is going to be super helpful. There are a lot of people who are thinking short-term rentals, but also business owners and real estate investors are technically business owners, so they get to take a lot of those
Mhm.
deductions for their business. And so this, I'm sure, is super helpful
Absolutely.
for all of them. And we have a link in the show notes for those of you trying to get in touch with Nick. This is going to be on YouTube, Facebook, and in the chats also. Again, I've used Nick and his team for a few years now, and I ask tons of questions. It's always back and forth. So I love someone who is working with me, and I think that's the best part. I really appreciate this so much. Thank you, Nick.
My pleasure. Thank you for having me.
I'm gonna skip into Q&A now. Nick, I think we have quite a few questions, so let's get to that. And I
Let's
had some
do it.
questions I was reserving for Q&A just because I didn't want to overload it. A lot of people are just getting started and can be a little much. But can we start? I'll start off with my questions first, but can we talk about people who own medical office buildings, Nick, and
Hmm.
how they can potentially group their practice with the building,
Yep.
if they're, separate entities, and how they can use that too, because our students have done that to shelter, like, again, hundreds of thousands of dollars of their clinical income from taxes. So how would someone do that? What are the pitfalls that they need to think about?
Yeah, I like this strategy because there's different ways to do it. Usually people have separate entities for their rental side and their medical office. There's um, several different ways where you can combine your entity structure and different options and variables in place. But really, we look at what it usually boils down to is how we structure the purchase of the building. There's pros and cons to each. If you purchase the building in a separate entity and rent it to your medical office, there's drastically different tax rules than if you purchase the building in the medical office entity itself. So people who are looking for a major tax write-off usually will purchase the building in the entity that the medical practice operates, because you're a material participant in your own medical business. So by default, the building and the expenses associated with the building, all the costs like property taxes and mortgage interest and insurance, that'll all be deductible business expenses for you against your practice income, along with depreciation. So you can do a cost seg and get bonus depreciation and a humongous write-off against your non-passive self-employment income, which is a big difference. If it's in a separate entity and you're renting it out, you can still do that strategy, but self-rental rules complicate things. So if you're renting to your own entity, losses are generally passive and income is generally non-passive. So
Mhm.
it's a funky rule with self-rentals that you don't really find elsewhere in the code, where the character of the activity changes based on whether there's income or loss. You don't normally see that. So it's something that we're careful of, but there's a time and a place to use strategy like that. Sometimes asset protection takes precedence over tax planning, depending on the situation. But there are different ways to achieve different goals by making the same purchase. So it's really important to get out in front of that, because if you make the purchase, it can be difficult to title transfer, and there can be implications of that depending on what your entity structure is. So it's really important to have those conversations from the beginning, but a lot of opportunity there, to reduce some taxes.
Is it possible to purchase it in a separate entity and then group both entities from a tax perspective in the year of acquisition and still be able to tap into those losses against the clinical income?
There are certain rules with common ownership and certain thresholds that you might be able to do that. It gets a bit complicated, so I wouldn't blanketly say yes, but it's possible.
Okay. So I'm just going to go into the rest of the questions for a little bit and then hop back to mine. But there's a question about, so Nalini, and you can unmute Nalini if you need to, owns a primary residence that she's moving out of and she wants to convert into a short-term rental.
Hmm.
And she wanted to know, and so if this is a year-end thing, so if she's running it as a short-term rental for, say, a few weeks this year, how does that affect, what is her ability to bonus depreciate, if at all, that property and use those losses?
So if you move out of your primary residence and you never rented it before, and it's the first time you're converting it into a rental, in the IRS's eyes, it's as if you purchased it this year as a short-term rental. When you place it in service for the first time as a short-term rental, it's eligible for bonus depreciation. Now, in one case, if you were to rent it out for a little while and come back and move back into it, you're not going to be able to do the cost seg and and short-term rental loophole strategy. But if you move out and maintain it as a short-term rental, quote unquote, permanently for the foreseeable future, you can do that if you convert it permanently to a rental. So it really depends on the use. And when you get to the end of the year, you have to understand that the IRS is going to have eyes on this transaction in an audit. They don't know that these things happen at the end of the year when they look at the tax return, because the tax return is an annual form, so you can't really tell when things happened. But if you're audited and they see the in-service date is December 1st, and then they see, next year they ask you for what happened to the property the following year, and you say, well, I moved back in January. There's no way that would fly in an audit. They would disallow any losses. But if you can show them that there's history that you continue to rent the property on a short-term basis, you ran it like a business, separate entity, separate bank accounts, separate processes, separate books and records, you solidify yourself as running a business, and it adds credibility to, even though it was a late year in service state in the previous year, it solidifies that and adds credibility. So it really depends on how continuity and intent is important. And
Okay.
just because the year closes out doesn't mean that you have to you shouldn't be mindful of how you're still operating it.
So, and I'm going to have Nalini, you can unmute yourself and
Yeah,
ask. Okay, I know you have a follow-up question. If she runs it as a
yeah,
short-term rental, like few weeks this year and then all of next year, and the following
Mm,
year she feels like this is too much, I want to make this a midterm. She lives in Phoenix, so it's a good market for a midterm rental.
hmm
So 2026, she says, I want this to be a midterm or a long-term rental. I want it to be hands-off. Is that still audit proof because her intent was to run it as a short-term rental, or is there anything she needs to look out for, say, a few years down the line if she wants to convert that into a midterm rental?
The longer you hold, and I'm sorry if I know you unmuted yourself, so if you wanted to add anything before I answer,
yeah.
I'll let you.
Nick, so I there is one thing while you were mentioning. So we rented this house for a year when we moved to Phoenix, and
Ah,
then we bought the house. So I don't
oh,
know.
oh, okay.
No, we didn't rent it to somebody else. We
I
rented from the
understand. I understand.
owner, and then we
Hmm
bought it. So now, I mean, long term is like we want to move to a bigger house. It was just like a starter
Sure.
home thing. So we want to move out, but it is a good market for midterm for next year if we can run it as a short term. But I don't think we will come back to the house. That intent is clear because of, I mean, we are looking to buy a bigger house.
Understood. Okay, yeah, thank you for that clarification. So that wouldn't the fact that you rented it as a tenant wouldn't prohibit you from doing this strategy, so that's okay. The thing with intent is it's hard to prove, right? If you didn't have documented intent and you're audited and the IRS says, well, I don't think that you meant to run this as a short-term rental, prove to me that you did. That was your intent. It's really hard to prove an intent. You can't fill out a form or something like that to prove your intent. So we need to have some kind of way of substantiating that. And the longer you hold a rental property in a short-term rental state, for example, uh, the more credibility it adds to that intent. So, if you're holding the property for a month as a short-term rental and then convert it to midterm, it wouldn't work. Over a year, that's good. And to document, I wouldn't necessarily say anything is 100% audit proof, but you're building confidence in your argument.
Got
And
it. I mean, we can still run it as a short-term rental. If the numbers doesn't cash flow down
right.
the road, that's when I would probably be a little bit worried about like continuing to run for short-term rental. But it's
And that's a
still a
perfect
good,
example.
yeah,
Yeah, it's a perfect example. Like looking at your financials, having documented financials, printouts of your monthly statements, conversations with a spouse or a business partner or a realtor or a CPA or anybody that says, well, let's look at these numbers. Is this working? We've gone through it's a short-term rental. Like Phoenix, I'm sure has slow periods and hot times of the year for vacancies and for
sure,
bookings.
yeah,
So,
yeah.
depending on how the numbers look, if you go through a whole season and you say, well, I'm entering the slow season, let's get somebody in there for 2 or 3 months. And if that seems to work out better for you, there's logic behind why strategies change. We just have to be able to show the reason why.
And the
So
cost
documenting
segregate,
conversations is important and everything
sure.
that comes along with that.
Sorry, and cost seg would apply as if this year is the purchase year. Am I correct on that?
Yes.
Okay. Okay. And
Awesome.
bonus depreciation would still apply on that. Yeah, great.
Yeah, at the
Thank you
original
so
purchase price, not what it's worth now, but what you originally bought it for.
I see. Okay. Okay. Thank you.
That's really helpful, Nick, because I
Yeah.
wasn't very clear about it. So I was like, wait, next week we're getting Nick on. Let's ask him. So thank you for
Sure.
Yeah.
chiming in.
Really appreciate it. Thank you.
Of course, my pleasure.
And so, Nick, the next question is going to be about IRAs. And I had a question about that too. So if we can talk a little bit about, Elias, their question is, if you use a self-directed IRA to fund syndication investments, can you offset W-2 income with it as opposed to if you use your own savings? So I think they're trying to compare funding it with savings versus using an IRA to fund syndications, how the tax implications are different. And then the second part to that is same thing with a short-term rental. If I were to purchase that outside of my IRA versus with an IRA, let's just overall talk about differences in terms of tax efficiencies over there.
Okay, these are really good questions. And there's a lot to unpack here. So I apologize in advance if it's a long-winded answer, but I'll try to get through it as succinctly as possible. But there is a lot of very meaningful differences here that could sway your decision making. So self-directed IRA, the first thing to understand about self-directed IRA is that anything that happens under a self-directed IRA won't offset W-2 or any other income. Completely separate entity, completely sheltered as a retirement vehicle. There's no tax advantages in terms of reduction because it's all sheltered under one roof. Is its own separate, complete vehicle. That's the first thing. The second thing, when you're using a self-directed IRA, I'll jump to the second question first because that's probably a little bit easier to talk about. You wouldn't be able to do the short-term rental loophole in there or any business that you materially participate in or actively participate in. Anything within your SDRA has to be 100% passive. You have to have a property manager. You can't even go over there to fix the toilet. And nothing, you can't have any interaction with the property at all, or that can invalidate the entire IRA. It's a prohibited transaction. The IRS is extremely serious about keeping it that way. So if there's any suspicion of that in an audit, it doesn't only subject the rental property in the SDIRA, but any other investments in the SDIRA to becoming taxable. So it really have to be 100% passive. Syndication is a good way to do that if you're looking for passive investments because you don't really have control of the day-to-day operations or management decisions. So that's important. That goes for real estate or any other business too. Short-term rentals, flips, or any other types of, even if you invested in some other kind of a business within there. The first question is a good one and probably the one that will take a little bit of time, and that's funding a syndication because normally syndications are leveraged. So the underlying asset in the syndication is being purchased with a mortgage. When there is leveraged investments with the self-directed IRA, if you buy a rental property directly and you take a mortgage out, or if you invest in a syndication that uses a mortgage to buy a property, or you invest in any other investment that is using leverage to make the investment or make the purchase, you're creating what's called UDFI, unrelated debt financed income, which is a form of UBTI, unrelated business taxable income, which generates, maybe you've heard of UBIT taxes, unrelated business income taxes. What that means is that the self-directed IRA, if there's income within the IRA from a leveraged investment, it could generate a tax. It requires the IRA to file its own tax return, Form 990T, and the tax rates are brutal. It's the same as individual rates in the sense that it goes from 10 to 12 to 22 to 24, 32, 35, 37. So it has the same numbers, but the width of the brackets is much, much, much thinner. For example, if you're a married filing joint taxpayer, you don't hit the top tax bracket until your taxable income is around $600,000-$700,000 in 2024. To hit the top tax bracket in an IRA, which uses the trust tax brackets, it's about $15,000. So if you have significant income from a leveraged investment, you could be paying 37% in no time. And that's in a protected vehicle. That's a retirement that you're not supposed to pay any tax on. So I'm not usually an advocate for using a self-directed IRA to invest in leveraged investments because that's one disadvantage. Also, you lose the benefit of depreciation because there's no income in there to offset it. It's tax-deferred account. If the property sells, you lose the benefit of long-term capital gains rates because it'll sell in the IRA and it won't cause a tax then. But when you take it out of the IRA, it's ordinary income. So you're losing the benefit of long-term capital gains rates. And also, if you're near retirement age or you will hold these investments until you near retirement age, you're going to have required minimum distributions from your IRA. So if you're holding illiquid assets where you don't have the ability to or the control to sell or to refinance, you're not going to be able to pull any money out of the account when you're required to, and there's significant penalties for that. So all of these things in mind, I don't normally advocate for doing leveraged investments in a self-directed IRA. If you have a self-directed IRA, home run investments that we look for are private lending, note investing, something that involves like interest income, because that's a very difficult form of income to offset outside of retirement. All that said, if that's where the money is, and
That's the problem for most people.
Yeah,
It's that if
don't
you have
pass up a
capital
good deal.
if you have capital for investing outside of your retirement accounts, use that. But the
Exactly.
problem is that the bulk of people's savings is in retirement accounts. And then when you're thinking of asset allocation or diversification, that's where the
Exactly.
disadvantage
Don't
is.
pass up a good deal because it's still better to earn income and pay tax on that income and profit the net, right? But if you have the means to do so outside of retirement, I'd look
Yeah,
there first. If
absolutely.
not, just be mindful that you have an obligation. You don't want to go
Yeah.
4 or 5 years of investing in syndicated funds in your SDRA and not have filed any tax returns. So just be mindful of the obligation and be aware that you may have to pay tax out of a retirement account that you may have to come out of pocket for. Um,
Those are very
but
valid points. Very valid
yeah,
points, Nick. Yeah.
all part of the tax planning.
Yeah, amazing. Okay. I think that answers both parts of that question. So we'll move on to the next one. So now, I have a few in the chat, but I have one that Aiden, can you pop any questions from Facebook and YouTube into the chat for me also, please? You mentioned a duplex, right? So if someone has a duplex or a triplex and they're using one of those units as an STR, Nick, are they able to prorate bonus depreciation and use it for that one unit as opposed to doing it for the entire unit? Because I believe we've had some students who've done that. Is there a strategy around that? If they have 2 out of the 4 units that they're running as STRs, are they able to bonus depreciate just a fraction of the the building?
The only way you can do that is if you're living in the other unit. If you're splitting it between like if you have a duplex and you're living in one unit and an STR out of the other unit, you can take 50% of everything and deduct it. But if you have a duplex where you're doing midterm or long term on one side and short term on the other, and the average length of stay is over 7 days,
Got it.
you wouldn't be able to do the loophole.
So the entire unit is considered as one for the average, the length of stay,
That's
essentially.
right.
Okay, perfect. I have one question for you regarding, so a lot of the people on here are likely acquiring a short-term rental before the end of the year. They may do some rehab on it before they place it in
Mhm.
service. I wanted to talk about partial asset disposition, a de minimis safe harbor, and expensing versus adding to basis and depreciating. When they're at the stage where they're thinking of doing these rehabs, is there anything they need to keep in mind so they can be strategic about the timing of the rehab?
Yep, absolutely. If the property is placed in service this year, that's the hard part because, or I guess I should say the easy part because
Yes.
it's already in service. You do a cost stick on the purchase, that's going to be your biggest benefit. But if you're
Yeah.
doing major renovations, anything that you can complete by the end of the year is helpful because, as you mentioned, partial asset dispositions, you get to write off the undepreciated amount of the original purchase asset that you're now scrapping and replacing. And you also get to capitalize or write off the new replacement item. So anything that you can do in this year will just accelerate your benefit. But it has to be paid for and in service this year. So, paying a deposit for something that hasn't been completed or installed until next year, it wouldn't work. It has to be actually, ready to go and paid for this year.
Does the asset need to be placed in service prior to the rehab to tap into partial asset disposition as an active loss this year, or is that incorrect?
Well, the asset has to be in service. So partial asset disposition is a result of original cost seg. So to have an original cost seg, the original property has to be placed in service beforehand.
Okay.
But once that is disposed, once something you replace is disposed, it's on disposition that you'll get the partial asset disposition write-off.
Okay, so they don't have to, the property doesn't have to be placed in service prior to disposing of prior to doing the rehab. They can still get partial asset disposition even if they place it in service after the rehab. They acquire, get the
Yes.
rehab done, and then place it in
Yes.
service. Okay.
Yeah, it just wouldn't be this year most likely in that case, but yeah. Mhm.
Okay. Okay, awesome. Just a few more questions. Shri says she's under contract. Congratulations, Shri, for a
Mhm.
long-term rental, planning to close in the first week of December. That's awesome. Do I have to find a renter before 2025 to qualify for 60% bonus depreciation is her question.
Yes. If you're targeting a short-term rental loophole, you have to have at least one stay, preferably two,
I think she's
preferably.
talking long-term rental is
Oh,
what she specifically said.
assuming you qualify for reps, then if you qualify for reps, the laws are a little bit more loose on long-term rentals. Uh, maybe not. That's the best I can give you because up until 2022, we were a lot more aggressive with that strategy about not reporting any rental income on the line as long as it was in service and we could prove that it was available
Yes.
for rent. We didn't
Yeah.
But in 2022, there's a tax court case specific for short-term rentals that said you
Okay.
need at least one stay, because if there was 0 stays and zero revenue, you
Hmm.
can't calculate an average of less than 7 if there's no
Right.
stays.
Right.
So that logic hasn't been applied to long-term rentals, but I guess you never know if there's going to be guidance in the future that will require that. So for right now, if that would be a conversation. If you're comfortable taking that risk of no stays for a long-term rental property,
Mhm.
that's a conversation. Short-term rentals, though, you need to stay.
Perfect. The next question is from Pavan. He says, if I have rental loss for 3 months on a long-term rental, can I write it off on my W-2 income if my wife has real estate professional status?
Yes. If your wife qualifies for reps, the real estate losses can offset your income, even if you don't qualify for a real estate professional.
And then Gautami has a question. We plan on closing this year. Do we have to have a booking this year? I think you kind of answered this. To tap into 60% bonus depreciation. And then do we automatically go into 40% if we don't have any bookings? And I believe the answer to that is it's only if they qualify for material participation next year that they're even able to tap into the 40%, right?
Yeah, this is tricky because like if you have a short-term rental and you actually are in service, if you to place a property in service means it's ready to and livable and available for rent. So like if you put a property on Airbnb and you gave people the opportunity to book in December,
Yeah,
technically you're in service in December, but if you have no stays, it would be a passive property because you can't prove that it was short term, even though it was listed on a short term platform. So it would technically be in service in 2024 as a passive property. And in 2025, even if you materially participated, you wouldn't be able to do bonus depreciation unless you did like a 3115 filing,
right.
because it would be in service as a passive property. So that would really be the worst case scenario. So if you don't think that if you can't guarantee that you'll get at least one booking this year, I wouldn't even list it or place it in service until next year and just settle for 40% bonus depreciation.
And then 3115 filing, do they have to wait an additional year before? So would it have to be 2026 when they can try to file that, or?
There's differences of opinions. If you want to take, yeah, usually we like to wait a year because of how the guidance is written. There have been times we've taken aggressive approaches. Again, it depends. And we talked about this personally
Yes,
for
I
you,
know.
and yeah, so
We went
that's
the
an
conservative route, like always
we went the
conservative.
conservative route
Nick
because there's a lot
always
of other
gives
stuff on the
me,
returns, and yeah,
yeah,
it's situational.
yes,
So we like to be we like to consider all angles because remember the goal is these advanced tax strategies is putting a target on your back for audit. That's the reality of it.
yeah,
And we want to be able to, I mean, in the past, I'd say year and a half, we've had maybe 6 audits.
yeah,
Prior to that, I hadn't seen an audit in over 10 years. So they're happening much more frequently. Won
yeah.
all of them, by the way. But we want to be
Congratulations.
prepared. That's
Yeah,
the thank you. That's the goal, is to be prepared, because if we can't, we can put anything on a tax return, but if you can't keep it at the end of the day, we didn't really do our job. So look at all the facts and make sure that we'll be able to be in a position to defend you. Um, so in this case, I would say, yeah, like just to go back to that question, if you're not 100% sure, I would just push it off till next year. But keep in mind too that a short-term rental stay doesn't have to be through Airbnb. You can have a friend stay there. It doesn't have to be through a platform. You can have somebody stay there as long as it's legitimate. You have a renter agreement. You see the money hit your bank account. It's fair
yeah.
rent. It doesn't have to be booked through a platform.
Yeah, and it has to be fair rent, so that
Mhm.
it qualifies. And I remember we had this conversation. I was like, no, why don't we just do it? And you were like, I think it'll be safer for us to wait. And I listened to you, and I'm glad I did. So
Yeah.
we
So,
have,
just
sorry, go
sorry,
ahead.
Param.
Yeah.
Just to follow up on that. So, what I'm hearing is that unless we are confident that we can get at least one, how many bookings are needed? One or two, or do
Technically
you?
one, ideally two.
Okay. So, unless we have that confidence, you're saying not to put it on the platform to go on Airbnb or things like that, right?
Yeah, because then you wouldn't really have the opportunity to do bonus depreciation next year. You would lose the ability to do cost seg instead of just gaining the ability to do 40% bonus depreciation.
I heard you can
I
tell
see.
your friends to book it, like maybe they can.
Right, that's what Nick was saying, but you don't have to use the platform. You don't have to
Mhm.
use the OTAs. If you can market it to your community of friends on WhatsApp and say, hey, we have this property, this is the rate we're giving it for, and this, it looks amazing. Take a look at this. And if they book through you, then that still qualifies.
Yeah, and like I said, I've
So,
been through these audits, so they're going to ask for bank statements. They'll want proof that the money hit your account, and they'll want to see They ask for renter agreements. They want to see that there was a signed agreement for somebody to stay there, even if it was your friend. And they want to trace the amount in the renter agreement to your bank statement. And if they don't see that, if there's a discrepancy, it'll invalidate the entire strategy. So it's easy enough to say my friend will stay there, but in order to pass, like how you win an audit, you have to legitimize it. But yes, you can do that.
So, follow up on that is that with regards to the 40% depreciation, so you're acquiring the property in 2024. So how
Mhm.
does it go into 40% depreciation if you're acquiring the property in 2024?
Because it wouldn't be placed in service until 2025. So it's the in-service year that matters.
Not the year when you acquire it. I thought the year of acquiring the property matters, no?
No, going back to
Okay.
the other example we just talked about a little while ago about living in the home for a few years, for example, when you convert it to a rental, it's the year you place it in service. So whenever it's first becomes a rental, is the year that's important.
I see. Okay. Got it.
So
Thank you so much.
You're welcome.
I have one question, Nick, probably two questions. That's it. No more after that, promise. This question,
No
I've
worries.
spoken to Diane. I would think so the last few weeks I've been speaking to people and they ask me interesting tax questions. I'm like, hop on the call. Nick's going to answer this for you. So this one's from Diane. We talked about this. So her spouse has farming income. Their question was, and I asked them to actually ask their CPA how it hits them. Is that considered passive or active income? Because they're investing in our syndication. And we were trying to see if the syndication losses would, how that would, affect, because if someone has passive income, then the syndication losses, time value of money, you're using those losses right away. It's super beneficial.
Absolutely.
So she says her husband has a farming business, LLC. They rent farmland. He hires an operator to plant grain in the fields, and then they sell the grain to local grain elevators. Would this be considered passive or active income? And yes.
I'll be honest, farming income has very specific and separate tax laws that don't apply to other areas of the code. And I'm not familiar or an expert with the farming aspect of it specifically. So my general answer would be normally, if you don't materially participate in the business, if he has an operator there who's doing more hours than him, chances are it's probably passive, but there are special rules with farming. I don't know if that applies in this case. I'm sorry, I don't think I'll be the best person to answer that one, but generally, I would lean towards passive, but you probably want to verify that.
Absolutely. Last question, Nalini, if you want to unmute and ask this question, and then we'll wrap it up, guys.
Yes. I mean, the house needs a little bit of work. So in case if we are not able to get, this is the primary home changing into STR, sorry. So if we are not able to finish all the work on time before we put in on service, and we move some of the work towards the beginning of next year, because the plan is to continue as a short-term
Mhm.
possible as long as possible. So then bonus depreciation, my understanding is like, for like they do for this year in the service, right? Like that whatever expenses we have for next year, is that goes into expenses, or is there a better strategy to get it done, and take a good advantage of the bonus depreciation?
Yeah, the purchase is going to be your biggest benefit. So any improvements that you do outside of the purchase, unless you're doing like a knockdown and a complete rebuild, the purchase is going to be a way bigger benefit. So our focus at this close to the end of the year is really the purchase. So if you can place the property in service this year, qualify, do your bonus depreciation, and then defer some of the improvements till next year and sacrifice the 20% difference in bonus depreciation on some of the improvements, chances are a lot of the improvements are probably going to be capital assets that aren't bonus depreciable anyway. 39-year property, if it's a short-term, 27.5-year property, if it's a long-term rental. So I would say if the property is in livable condition, place it in service, get a couple stays there, and then refurbish it when you get to block out some dates and do some repairs
And then
next year.
Okay, sounds good. And then if when we do it for next year, right? So because we have a little bit of real estate portfolio, and let's say my husband wants to participate with the reps, those hours we can use towards the reps, even though it's a to participate with the reps, those hours we can use towards the reps, even though it's to participate with the reps, those hours we can use towards the reps.
I'm not sure what happened there. I think I lost that question halfway through.
S- So sorry, that must have been me. I had Facebook open on my phone and I was like, what is
Oh.
this weird? So sorry about that. We're
Yeah.
good. I'm trying to answer the questions on there because I think there were a few other questions. Even if you could just pop it in, there's one from Anurag that I think we may want to take. Sorry, go ahead, guys.
So I think I'll start over. So if we want to do reps for next year, these hours that we put for the house improvement thing, could those be also be counted towards the reps for, even though it's a short-term rental?
I think I understand the question. So I guess there's two parts to the question. Any hours spent this year wouldn't count towards
No,
next
it's
year,
next
even if
year.
it's the same process. Yeah, even if
No,
it's the same process. But if it's next year,
yeah,
hours spent on a short-term rental don't count towards reps. Those are separate buckets. So if the property qualifies as a short-term rental for the whole year,
yeah.
any hours spent there wouldn't contribute to your
Would
reps
it contribute?
hours.
Okay, all right, thank you.
You're welcome.
Awesome, Nick. I think I may have one last question. Hold on one second. Um, okay, that's okay. I think there are a bunch of questions and I don't know where to start. So we'll just
Okay.
it's 6:10. We'll let you go, Nick. Thank you so much for doing this. I learned something new. I learned quite a few new things today, so this was super helpful for me
I
also.
love that.
And
Glad to hear
guys,
that.
there are so many questions. I know you guys have tons of questions. Now, Nick's team, they do both tax prep and tax advisory services, and those are two very different things. So, if you want to get more specific questions answered, feel free to connect with his team. And, it doesn't have to be, just for tax prep. You could also get a tax strategy, tax advisory session with them, and then they can go over everything, take a look at your whole portfolio, and you have the ability to connect with them. Okay. Thank you so
Absolutely.
much, Nick.
Thank you guys. Yeah, I really appreciate it.
I'll let you go, Nick. You are on the East Coast, right? So it's pretty late
Um,
for you. Are your kids in bed already?
kids are in bed, but this is where I get some real work done. So
Yes,
nice just
yes.
starting.